Welcome to the current federal tax developments for the week of September the 24th, 2018. Current federal tax developments are brought to you this week by Kaplan Professional Education and by your state Society of CPAs. This week, we're going to look at 4 different issues that came up this week. We're going to take a look at a tax court case where a taxpayer was attempting to prove reasonable reliance on indirect legal advice. That's kind of an interesting problem. We have an updated safe harbor explanation for plan distributions from qualified retirement plans were issued by the IRS this week. The IRS announced, after a lot of complaints about the complexity and issues with privacy, about the new W-4, they're going to go with the brand new format in 2020. They're going to just revise the 2018 format for 2019. That was announced this week. And we'll also discuss the relief that was announced for the victims of Hurricane Florence, filing relief very similar to what we saw a year ago with the hurricane relief that came down. We're going to see that very similar this year. So to get ourselves moving, let's start first with this case we talked about reasonable basis. Do you have a reasonable basis for reliance on a taxpayer or on a tax professional in a case where you are getting advice indirectly? This particular case was the case of Beller Woods, LLC versus Commissioner. Tax Court Memorandum Decision 2018-159. It was issued on September the 20th. And what this decision did was it took a look at a question involving a conservation easement. We have a taxpayer here, in this case a partnership, that was attempting to claim a contribution for a conservation easement. For those of you not aware, that's one that's been of a lot of interest to the IRS here recently. We've had a lot of cases on conservation easements. This particular case, though, was tied up by one particular issue that kept us from having to worry about whether they properly valued the easement or any of the other issues. That was the taxpayer had failed to follow all of the requirements for claiming a deduction for a non-cash contribution. In this case, the taxpayer had omitted the basis information from Form 8283. Remember, on that form, when you make a non-cash contribution, you're required to provide information on basis as part of the, in this case, for qualified appraisal, because it was a value of over $5,000. You're required to submit that information. The taxpayer left that off the return. Now, of course, the IRS said, wait, the regs say you have to use this. And, it has to be there. And if you don't, you lose the deduction. Well, the taxpayer said, no, because we'd done this. We'd worked with a consultant. And this consultant, Forever Forests, had helped us structure this deal. And when we went back to them and said, okay, how do we report this on our tax return? Well, what Forever Forests gave them or came up with was they cited a information about a memo they had received from an attorney. And it's a memo, though, they'd received earlier, a few years earlier. And it had told them that, reviewed its instructions to Form 8283 and had concluded that it should not be necessary to include basis information if you attach an explanation to Form 8283, providing a reasonable cause for why it is not included. The memo went on to state that a reasonable cause for not including basis information should be the base of the property is not taken into consideration when computing the amount of the deduction. A couple of things to point out here that are important about this. Number one, we'll talk about this. The court will eventually hold that this is wrong. But secondly, realize this was advice given by an attorney to a entity who was involved in structuring and potentially, we might even say, promoting these structures. And now the taxpayer went to them. They said you could leave this off. Now the taxpayer is in trouble because regulations say you have to include it. And so the taxpayer said, no. First thing is, look, as the attorney said, this is irrelevant. You don't need it because the deduction is based on the fair value. And regardless, unless the fair value is, if the fair value is less than our cost basis, we're going to have to take that, and it's not, nobody's alleging if we sold it, it wouldn't be long-term capital gain. So really the basis is irrelevant. Well, the tax court said, no, guys, you miss it. Congress added this to the law specifically to help us find structures where it appears that somebody is grossly inflating the value of the conservation easement. For instance, if you acquired the property a year and a half ago, it was worth $100,000. And oh, by the way, then suddenly now, a year and a half later, you're claiming you donated a conservation easement for this property, and that easement, this partial limitation on use, is somehow worth $10 million. We might have reason to worry about that valuation, separate and apart from having to look at any details inside of that. Just it's easy to say this is a return we should look at. When you omit basis, that's not an inconsequential item. In this particular case, there was an issue about a significant difference between basis and fair value. And as the court pointed out, this donation was made in the middle of the biggest real estate slump we had had for a long time. In essence, why had this property supposedly grown so dramatically when all the property around it was going downhill? And they're saying, that would have been an issue for the IRS to have wanted to look at. And what we're claiming is, the claim fair market value was over $4,700,000 was what they claimed was the value of the easement. So the court said, guys, no, that's not right. In essence, the attorney's conclusion that you could leave this off and a reasonable basis for doing so is because, it just wouldn't matter in the deduction. It's like, no, guys, sorry, that's wrong. Congress intentionally said, if you want to take this, you have got to provide the basis number. We don't care about whether or not you might think it's irrelevant. Yes, ultimately, it's not relevant, but it is very important for the service to enforce this rule. And Congress said, if you're not going to give us that information to let us enforce the rule, then what we're going to do is we're just simply going to deny the deduction. Okay, so on the merits, we lose this. Well, they said, okay, second point. Well, we basically complied. We were really, really, really close in compliance. And that, in fact, essentially we had substantial compliance. And that's a doctrine that has been used in rare occasions to allow deductions in cases like this. But the tax court said, substantial compliance doesn't really work in this case. You intentionally, it wasn't an accident that this got left off. It wasn't due to a misunderstanding that you didn't include this. No, you didn't want to give it because, to be quite honest, it really did make it look bad. And because of that, we're not going to give you substantial compliance for omitting this when that was an intentional act on your part. You knew that the regs said it had to be there, and you intentionally pulled it off. Now you pulled it off claiming that the law didn't really require it because, as we'll get to shortly, there was added in 2004 a reasonable basis exception to this rule. But they're saying, but reasonable basis is not, we want to omit it just because, you know what, we don't feel like turning it in. That's not reasonable basis. However, the court said there is an issue here, though. Reasonable basis as a position, as something that we work with in the tax law to get out of penalties. One of the key ways we show reasonable basis is that the taxpayer sought advice from a competent professional, that the taxpayer, gave the professional all necessary information, the professional gave advice back to the taxpayer, and the taxpayer reasonably relied on that advice. What it is, the key issue for reasonable basis is, did you take action to reasonably try to, as best you could, fully comply with the tax law? And the court said, there actually is a question here. So IRS, we're not just going to give you the win straight out. Because of reasonable basis rule, we're going to consider it. Now, there are a lot of potential problems with the taxpayer winning on reasonable basis here. The court says, look, we got to know all the following things, to figure out if we have reasonable cause. Was the consultant a tax professional? And even better, were they a competent and independent advisor unburdened with a conflict of interest? Now, that will be probably a bigger problem with Forever Forest if Forever Forest was only going to be paid if this deal went through. Or if there was a provision there that said if the taxpayer does not get the deduction, that Forever Forest is going to refund the fees. If there are things like that, then you may say various issues suggest that Forever Forest had a reason to want you to push forward with this. So that could also be tough. Are they an advisor? That's also tough. That's going to depend on who's on staff and their background. Uh, but can you look through and rely on indirect advice? The court apparently opened the door to that possibility, but I don't think it's by far a probability that you're going to be able to look through and rely upon indirect advice. And finally, whether or not this partnership should not have realized that regardless of this, if a professional gives you advice that is simply too good to be true, and you know it's too good to be true, you're not reasonably relying on it. If I tell you that, yes, we bought this piece of property a year ago for 100 grand, the market's collapsed. We just gave away a portion of the property and it's now worth $20 million, that portion we gave away. You might argue that's just simply too good to be true. That regardless of all of this, you were not reasonably relying on this, and you were hiding things. You knew you were hiding the basis because it indicated a problem. So while I don't know the taxpayer is likely to prevail in this case, we're not yet done with this case, or at least I'll put it this way. The tax court said go back. My guess is we may see some settlement on this. The catch is going to be whether Bel-Air Woods really believes they can carry this reasonable basis on the terms the tax court has given them. I think it's going to be an uphill fight, but hey, if they win, that indirect advice one could be interesting for some situations. So, see if a Bel-Air Woods 2 shows back up in our discussion somewhere in the future. Next up, we have the IRS in Notice 2018-74 on September 19th of 2018. They issued in Notice 2018-74, they issued updated safe harbor explanations for qualified retirement plans. These are the documents that a plan sponsor is to give to a recipient of a distribution eligible for a rollover that explains to them the options for dealing with this distribution, including the options for rolling it over. And they issue these every few years. Now, and they do it because they need to roll them forward to take into account changes in the law or changes in IRS rulings that have taken place since the last one was issued. In this particular case, since the last one was issued, we've had a number of changes in the law. Number one, under the Tax Cuts and Jobs Act, if the person receives a distribution from the retirement plan, and that distribution from the retirement plan is offset to repay a loan they had borrowed from the 401k, so we took $25,000 out of their distribution to repay their loan. Beginning with 2018 distributions, the taxpayer will have until the extended due date of their 2018 return, when they received the distribution, to make the rollover. We're updating this to tell taxpayers that they have that extra time if any of their distribution consisted of a loan offset. Congress added that because taxpayers often didn't understand that they had to roll over not just the $620,000 they got from the plan, but they also had to roll over that $25,000 offset at the same time. So it's not just the net check. Most often they got told that when they came to see their advisor. Now they're going to at least have a chance to fix it. The notice has been changed for that. There also were some law changes that allow some special cases where certain public retirees, generally law enforcement people, have more liberal options for rolling over plan distributions. And also they don't get penalized as quickly. The public retiree changes are put into the notice. So they have those brought in, and that's included in these model notices. They also remember, the IRS added self-certification for late IRA rollovers. Remember, in Revenue Procedure 2016-47, the IRS added the ability where if there is a late rollover into an IRA and you have one of the specified reasons in that revenue procedure, which covers most of the reasons why the IRS ever gave permission for a late rollover, you can self-certify. The new explanation describes the self-certification process, the issues under which it will work, and gives that information. If you are a plan administrator, if you are administering a plan, and it means if you're a TPA, or if you're one of those people, hate to say it, but we have clients that do this, who go out and say, well, I don't want to pay a TPA. I'll just go get a plan document from my broker, And, yeah, I know I got employees here, but I don't care. I'm going to go ahead and just run the plan. Well, they need to update their documents too, all of these things. Now, all of these explanations are actually two separate explanations in here. Explanation number one is for accounts distributions from designated Roth accounts. And the other explanation is for a distribution not from designated Roth. The IRS also makes clear you can modify these notices to omit things as appropriate for your plan. For instance, if you're not a public retiree plan, you don't really need all that information about public retirement options. If your plan doesn't offer loans, arguably you don't need the loan offset information. So you can modify them, but you should start using these new ones. In essence, you're not protected any longer. Also remember, these protections only apply, as long as the law doesn't change. So even if, you go ahead and use this notice, if Congress changes the law, you're supposed to update these notices and not wait for the safe harbor explanations to come out. Now, again, this updates the notices that we got back in 2014, in Notice 2014-74. So we had those notices. They were the prior safe harbor notices. They have now been updated under the new rules. So be sure that you've gotten these things taken care of, and be sure that you've gotten everything updated for your qualified retirement plan. If you are not a TPA, but let's say you're a controller and you sponsor qualified retirement plans, you probably want to check and make sure your TPA has updated any notice documents they're going to be using in order to comply with these new rules. That'll also be one of the things to be looking at. The IRS decided that in Treasury press release issued on September the 20th, the IRS gave into pressure and gave into a lot of complaints and decided that the revised new messy W-4 is not going to be used in 2019. Rather, we're pushing it back to 2020. In June, the IRS had issued a new proposed W-4. You may remember we've had issues from early this year with the changes made in the Tax Cuts and Jobs Act. The old style W-4 really didn't work, because remember, old style W-4, it really wasn't this way, but it's the way everybody thought about it. You said, look, married couple, 2 kids, right? So essentially, you claimed 4 withholding allowances. The theory was, if is a simplistic view of that. As we all know, that didn't really work if both spouses did that. That's another long problem that we had to modify. But for instance, single or head of household, mechanically, that's pretty much what you did. And if you weren't itemizing, it came reasonably close to what you needed. Well, now the Tax Cuts and Jobs Act got rid of those deductions for personal exemptions, gave us a credit that's larger for younger kids, for dependents that are 16 and under, but drops dramatically when they go above 16. We also have issues where the standard deduction grew dramatically. The credits phase out. We have all kinds of things that just make this into a bit more of a mess. So the IRS decided, well, the old way of doing it wouldn't work, but they had to get something in this year. So they went with a quickly modified version of the 2017 form for 2018. Then they said, we're going to go back and we're going to do this brand new system for 2019. And there were a lot of complaints about it. The catch was the IRS came out with a form that quite a few people would tell us required you to actually go back and do a full tax return computation. Now, for most of us, that's like, well, that's how we always did them, right? I think most of us will do a tax computation, then back into what the person had to put on the W-4 to get their withholding to come out to equal what we computed their tax was likely to be. That's always been a theoretically preferable way to do it, but it's never been the way the IRS told people to do it on the form, because most people are not going to want to do a tax return twice. Once for their own return, once again. Also, it means for a lot of people who don't do their own returns that they would have to go probably to a tax professional to fill in their W-4. As well, the schedules and other information that could be submitted with the W-4 to back up the numbers had a lot of personal information that raised privacy concerns of submitting that information to an employer. Even without those, you gave enough information on the form that you were telling things to an employer that an employer otherwise had no right to know. So people got very concerned about this structure. Because of that, the IRS has now told us they're going to revert to the 2018 format for 2019. So it's going to be just as imperfect as it is now, but it's going to be the same thing. Especially payroll companies are getting very, very worked up because, well, and everybody has software now doing payroll. Your payroll software has to be updated for whatever the new W-4 is, however it's going to work. And as the payroll companies were saying, we're running out of time. We are now approaching October, and we're now getting to the point where we need to understand, we have to start programming our systems for 19, and we need the new W-4, and you haven't given it to us yet. The IRS does still state they're going to be going for an updated, revised, changed version, but they're now going to drag it out to 2020. So they're going to claim they're going to give us a brand new draft of 19 and then quickly roll that out. Then we're going to go and start working on the 2021 now. And the theory being trying to design a W-4 that will more closely compute the proper amount of income. As you've heard lots of commentary in the press on, of course, because the 2018 W-4 is basically a kludge. It's something that was made to work, that we just had to get something in there, so we did it. It is far from a perfect, it is far from even as good as the old system was at determining proper withholding for a taxpayer. So yes, there are taxpayers who are going to find either have substantially too much withheld or substantially too little. Now, I don't know about your clients, but my clients who have substantially too much withheld may grumble a bit about getting no interest, but 9 times out of 10, they don't care as much. The people that suddenly owe tax that never owed in the past, those people tend to, shall we say, panic when this happens. So, you might want to suggest to clients that it might be a good thing to maybe run some projections here while we still have 3 months left in the year to see if their withholdings are really matching up with what their tax will probably be this year. There is that problem because with the change in the law, their tax very possibly has changed dramatically. Their withholdings may have changed dramatically, but the two may not be in sync. That's kind of a problem. Next up, IRS news release NC 2018-03. This was issued on September 15th of 2018. As you might expect, NC stands for North Carolina, and it's actually deals with the Hurricane Florence situation. It is meant to be relief for victims of Hurricane Florence that hit the Carolinas. And Hurricane Florence, as we know, we're still in the midst of, I think, the last I heard, some rivers are still rising, so we're still trying to figure out the full extent of this thing. But the IRS has already published some relief. And this relief is very similar to what we saw last year. Now, on the page that has this, and because this is a fluid situation, you should always go back to the IRS webpage and check to see if they've updated the list of counties or areas. What happens is, what tends to happen these things over time, especially until we get to where all the rivers have crested, all the damage has been done, we tend to see the IRS keep adding counties to this list. So even if a county is not in there yet, it may be in there shortly. Okay. But what they've done is they push most deadlines that occurred on or after September 7th of 2018 and before January 31st of 2018. Those are just going to be extended to January 31st of 2019. So that means things like the third quarter 941, that's just going to be pushed to January 31st. That also means things like trust returns for those in the covered areas will be pushed. Now, it covers taxpayers in those areas or who have businesses or records in those areas. Okay, so you have to realize who's covered. Okay. Quarterly estimated tax payments are due on September 17th are there. Payroll and excise tax returns, exempt organization returns are covered by this. And on payroll tax deposits, no, you don't get to January 31st, but any deposit that was due on or after September 7th of 2018, as long as you got it made by the 24th, that is considered to be a timely deposit. As with the previous hurricanes, we don't extend deposits all the way out. Deposits, and you're supposed to be back on your deposit cycle for payroll by now. Now, the IRS tells us that they're probably, in essence, so the IRS tells us they are going to try to identify affected taxpayers. In fact, they normally do try to identify. So if a taxpayer lives in an affected county, the IRS computers are supposed to catch this, and then they are supposed to not issue penalty notices. But let's say you didn't live in that county, but you had a business at county, or your records, your bookkeeper was in that county, your records were tied up and lost during this. If you get the penalty notice, the news release tells us essentially that you should essentially, call and abate the penalty, and try to basically, indicate to the IRS why it doesn't qualify. If you do reside outside, if you reside or have a business located outside the disaster area, but you're affected, you qualify otherwise, your books are there, other issues mean that you're covered, you can call the IRS disaster helpline, I'll get that out right, at 866-562-5227, and you can, on that line, request that they flag your account to provide you with relief under these situations. Well, it's a final week coming up now for me. I've actually got a course this week at South Dakota for South Dakota size CPAs, a couple of courses this week coming up on CPA firm best practices and on cybersecurity. That'll be coming up on Wednesday in Pierre, South Dakota. That's at their convention, I understand it. But otherwise, my CPE is pretty much done until after the October 15th dates, once I finish that up. But remember, after October 15th, we have a whole bunch of things happening. You want to go ahead and take a look at your sign up now for what your state society is offering for CPE courses this year. Stuff is coming up. We all going to need to get an update on where things are going with the Tax Cuts and Jobs Act guidance, because that continues to roll out. We're expecting the Opportunity Fund guidance probably, well, let's say not probably, but maybe this week. We'll see the Qualified Opportunity Zone guidance, so we're going to hope for that. And you're going to need to get up to speed on how that goes. So check your state society catalog. Be sure to look in there and sign up for one of our courses offered through the participating state societies. This has been the current federal tax developments for the week of September the 24th. You can catch our regular updates online at currentfederaltaxdevelopments.com. You can also, if you have any questions or comments, you can email me, edzollers at currentfederaltaxdevelopments.com. My Twitter account at edzollers. And I usually post there if I post anything on the website when we post updates. You can also find me on some discussion groups. I am the Reddit Tax Pro discussion group, Reddit/r/Tax Pros. I'll monitor that. I also monitor the Tax Talk group from Yahoo on Yahoo Groups, which is run by the California Society. I'm also involved at the moment in groups with New Jersey and Arizona. So if you see me there, we can talk about what's going on in those groups. Otherwise, we're going to look forward to, after I get back from Pierre, should be able to get something up and going for this week. We'll hope for the best as to what goes on. We'll see what we get. We'll see if we get those Opportunity Zone regs this week. So be sure to check in and find out what's been going on in the area of federal taxes in the coming week.